Today I want to talk to you about market cycles and what it means and how we can use it for us. Here we see, for example, the S&P 500. Pretty much looks like a more or less straight line up, right? It looks like only it goes up with little dips here and there. But actually, if we zoom in and really look at the intervals, you can see over here, you have a lot of periods, and we're talking about longer periods. You can see, between those 2 points, that was 2 years, right? And we know the reasons why it dipped for quite a while. So overall, there are a lot of cycles, which basically are periods of downturn followed by periods of upturn. And that basically you will see across any possible chart. If we go back here to 2008, 2009, we know the financial crisis at the time. Look, it was only going up nicely, but then if you really zoom in, it was a massive correction, right? And a lot of people think, oh, right now it's maybe expensive. They only zoom into that. But at the same time, we also shouldn't forget that in the big picture, if I once again zoom out, obviously the upward trend is pretty clear, right? So it doesn't matter. Even if you invested over here at the time, let me zoom in right here, once again in 2008, right? Just before the crisis, and you would have said, oh my God, I lost so much money. You would have lost around, 50% of your holdings. But if you held on to it, guess what? Yes, it would have taken a little bit of time, but obviously it recovered back in 2013. And from there, you would have had some major growth if you held on to it. But a lot of people panic. And that's why I think it's so important to understand the market psychology and cyclicality, meaning it goes in cycles, and how to use it for ourselves. All right, guys, excuse my poor drawing, but this is what we call a bull market. The prices are going up. You buy over here at the lower price, and you will sell over here at higher price. That's ideal, right? But that's actually market timing. You're trying to time the market, entering at the low point and then waiting until a higher point and exit the position. But the question is, do you exit over here? Do you wait longer over here? You'll be missing out and will be upset later on at the profits. I'll come to this in a moment. I'm going through these motions myself right now because you don't know where is the end. So that's why it's very difficult to try to time the market. That's why people say time in the market beats timing the market, which basically means if the market was to go down from here, right, and then it will go up again and go down again. But long term, if you invest in a good asset class, it might most likely continue to grow. So if you would have stayed the course all the while, you would have benefited from that in the process. In an ideal world, of course, you always want to be selling here when the price is low and sell at a higher point. That's the idea. And these are the cycles where we go. We go up and down from a bull market when the prices are going up overall to a bear market. And bear market is an overall downturn for a longer period. We're not talking about price swings. For example, if I go once again back to the S&P 500, we had the period not so long ago, April, 2024, it dipped for a little bit. But that's not considered a bear market. It's just a market correction, right? Because certain company, or in this case is S&P 500, so a number of companies maybe had bad earnings, what have you, especially the top companies, right? If they have bad earnings, the entire market is being pulled down. But overall, we're still very much in an upward trajectory. You can see if I zoom out further, since when is this? 2023, we've been very much on a bull ride. And really, we didn't have major market correction since, I would say, obviously you could consider, 2020, but even that didn't last too long. When we talk about bear market, it is really an extended period, as I've shown you before, such as the times of the financial crisis. But since then, for example, the overall market sentiment has still been very bullish and very much forward trajectory and momentum, right? So little corrections, that's normal, right? Not anything always goes up. Even the bull market, things correct and go down. That's good. There's something what we call short sellers who are betting against the market. You could take a short position. People who bet against the market and the prices fell, they actually made money. And that's part of having a dynamic market, that there's ups and downs. And I find this very interesting, for example, if we look also at interest rates, because interest rates are very powerful and influential on the entire economy, and all those numbers, all the investments we make, a lot of it often comes back to the interest rate. So here we look actually at the US federal funds interest rate since 1972, and you can see even here we have cyclicality, right? Higher interest rates leads to higher cost of borrowing. More people leave the money with the bank to get higher interest rates and spending it. So there's a lot of repercussions on that. And obviously governments also do that for specific reasons. In the latest example that we're in right now, as you can see, why it went up from all the way many years of almost literally zero, free money technically, interest, to now extremely high interest, even though when we look at previous periods, we saw it used to be even higher. So it's actually not that bad. It's all relative, right? Right now we're freaking out, it's so high, but even not so long ago, it used to be equally high, if not higher. But they do that with the purpose of bringing down inflation, right? Because as I said, more people keep their money in the bank, therefore less spending happens, less spending brings eventually the prices down. That's the wish, that's the hope. We see that slowly kicking in, and I think eventually we'll also come back to a lower interest rate, even though we've seen such a low interest rate not for many years, because the plan is once again with lower interest rates to have more stimulation of economy and so forth. But even here you can see cycles taking place, and that's very important for us as investors to keep in mind when we make our own investment decisions. For example, right now it really makes sense if you have cash sitting around, don't just keep it at home, because you're going to be losing out big time to inflation, because your money is getting worth less and less and less with every single week, every single month, every single year by not putting it into the market and making it work for you. So the bare minimum what you can do is take advantage of high interest rate accounts. And there's some great options out there. Myself, I use a lot of them. I use apps like Lightyear, Trading212, Trade Republic, Revolut to get the most out of my money. I get 4 to 5% interest without any lockup period. I can withdraw at any time. And honestly, by doing that, I mean, it's nice to get the money, but technically I'm literally just preserving my money. Because if I wouldn't do that and just keep it in my bank account, I would be losing out money to inflation. So that's very important to do that. But I think that's the bare minimum. At the same time, I also know that these high interest rates won't exist forever. Eventually, they will come down. And that's something you need to keep in mind, because once the interest rates come down, then honestly, it probably won't make sense to keep your money in such apps anymore, especially for the purpose of getting interest rates, because maybe instead of getting 0%, you might get 1 or 2, but that's actually not that attractive. Instead, you want to do other things with it. Give an example, I used to invest into P2P lending. That's supposed to be me. Well, I don't know, my drawing is not the best, but you get the point, where I would give money to a lending house and they would basically then pass that money on to people who otherwise can't get a, for example, a loan from the bank or for other reasons, and they would pass that money on to them. It's much easier to get it there than from a bank. And in return, obviously, they would pay the interest to the house, or the exchange, or whatever you call it. I used to have Pandora, but there are many different places out there, and they would obviously, pass the interest rate to me. So I would get, interest on taking the risk of giving the money, and eventually after some time, that person would pay once again the capital, the principal, back to the house, and the house would then distribute it, back to us eventually, me as investor. And that was really cool for a while. But once the interest went up, having done it in the past, I got around 6.75% without any lockup period. So it was quite attractive when the interest was very low, right? But now that the interest, as I said, I get anywhere from 4 to 5% interest on my money. So it's marginally less, but without all the risk. Because here, in case that person decides not to pay back or goes bust himself or whatever, I may never get back my full amount of money that I gave him in the first place. So it's very risky. In the past 2 years, when the interest was high, I didn't do that anymore. However, once we go back to very low interest, when I get, let's say, 1 or 2%, then all of a sudden the 6.75% becomes much more attractive. Here we also have the historical median home value of houses in the US. Again, you may not be investing in houses in the US, but at the same time, that's probably applicable for most countries where you live in as well, because in real estate, it's cyclical, right? We have, once again, high prices when interests are low. You get cheap mortgages from the bank, low interest. A lot of people buy real estate. Then obviously demand goes up and the prices go up. At the same time, if the interest rate goes up, borrowing money gets more expensive. I've been through that myself right now, and we had to take a mortgage. Right now, we're paying around almost 6% interest for the mortgage. So the payment is almost double in a month we have to pay back to the bank. Then it was initially at the lower interest rate of around 3%, right? Because it increased over the time. So now I have to pay twice the amount that I previously had to pay just by a couple of percentage in the interest. So that makes a big, big difference. So honestly, this chart of the interest rate is very important. That kind of almost dictates some of the cycles. Of course, there are a lot of factors in that to know what cycle we're in. Don't worry, you will hear it in the news and you will see it everywhere. We're in a bull market, we're in a bear market. You will see that overall. But keep in mind, there will always be some assets that perform stronger than others depending on the cycle we're in. Another great example is cryptocurrency. Now I understand not everybody invests in crypto, but still keep that in mind over here. A similar principle, right? When we look at the price of Bitcoin, obviously not so long ago, I wish I would have bought back here in 2014, 2015. I would be a wealthy man by now, but it is what it is. But I got in eventually, I'm happy I did. But even here you see a very strong cyclicality, right? You have some peaks over here, and even if I zoom in over here, obviously there's smaller ones, it just looks bigger because the amounts start getting bigger. But here you see, every couple of years, major peaks, and then it calms down. So you don't want to be in a position, obviously, to buy at the peak, right? Because afterwards, we always see little corrections. You don't see anything only going up. And right now, it looks like we're going to yet another all-time high. And honestly, eventually, most likely, it's a question of time, but it will come down eventually again. So that's important to understand. Even if we missed out the peak, as I've shown you before, you can either continue to buy because similar to the S&P 500 chart that I showed you before. If you bought back in 2008, guess what? If you held on to it, it will come back. So I think the same is true for Bitcoin. I keep on buying even at high prices, but of course, I will wait to have more cash in hand once the prices start falling to buy even more. So the idea is obviously not to market time, as I showed you before, but to dollar cost average. But knowing that there will be cyclicality, because nothing ever goes up, I know there will be a correction coming in. I want to keep more money that I can buy even more Bitcoins for myself. So that's the plan over there. And also one thing to consider, what that means right now, as you can very much see from the chart, we're really in a bullish territorium for crypto overall. There's so much excitement around. We've seen the Ethereum ETF being approved in the US now, which brings in, huge money into the system. So I think a lot of positive momentum across the crypto markets. And you see all of them really in the green, most of them at least. I think there's a lot of money flowing in and a lot of greed because everybody wants a piece of the pie and participate from the gains. Knowing that, I want to take advantage of that as an investor. While I have all my conservative investments in place and a lot of dollar cost averaging, which I always recommend for everyone, I'll come to this in a second. At the same time, also keep buying Bitcoin, which I really believe in long term. But at the same time, having shown you those charts and the momentum and the money and greed flowing into the markets, I thought I can also capitalize on it, make a bit of money to then reinvest into more conservative investments. Just to give you an idea, right now meme coins are absolutely hot. And honestly, meme coins are not something I recommend anyone to invest in. But as I mentioned to you before, right now I can really see some crazy numbers. I mean, look at the volume in the last 24 hours, $108 million flew into one single coin. And I don't want to promote any coin, so I'm not really putting it front and center. It's just something I found myself as a strong community to invest in. There's no value behind it. There's really nothing. It's just the hope and greed that's flowing into it. So I thought, why not play with it and make a bit of money from that as well? You can see the market cap now $350 million. Not so long ago, it was less than $1 million. So it's crazy, crazy growth. And honestly, I would not be investing if we were in a bear market, right? But now it's just stupid money. Really, I call it stupid money flowing into that. And people just want to participate from the gains. And there have been crazy gains. I mean, you can see over here for the day, that's my today's P&L by $3,000. For the day, the last 24 hours. Actually, it was at some stage $6,000. So it's absolutely, as I said, stupid money. And I know it won't last forever because it is very much cyclical. Right now, we're in the last phase of the crypto bull market, I believe, before we see a correction. But that's why I just want to, get a little bit more, then cash out. I'm already taking profits along the way and then reinvest them into more conservative investments, if you can call Bitcoin conservative, but in my eyes, it is compared to some of those crazy coins, which I really don't recommend anyone to do. Plus, of course, I will continue investing into the S&P 500 ETF, which is something I always recommend because you can't go wrong with that. As you've seen, I mean, the trend line is very much clear. So I hope by now you got my point that I think it's very important to overall understand cycles in the markets if you want to take advantage of it. If you invest into something that's solid and has a long-term potential, actually it doesn't really matter, right? If you just want to set it and forget it, you'll be good. If you have a solid asset that you invest in, you'll be good either way. I just shown you S&P 500, heck, even gold, right? I mean, you can see also cyclicality, but if I zoom out, I mean, overall, gold has also been doing well. It's not something I'm investing in. If you just left it over here, even if you bought it at quite a high price back in 2011, right? It dropped for a number of years. So again, I'm not a big gold fan, but still, even if you held on to it all the while, you would now be in the plus, right? So it's all a question of time. So you don't have to time the market. What I'm saying is, keep in mind that there will be cycles. And if you want to take advantage as an investor, just to maximize your returns even more, I think that's a clever move. So either you have set it and forget it, invest into S&P 500 or some strong ETF that you believe in and just put it there, dollar cost average every single week, every single month, and you'll be golden. If you have many, many years, if you have still many years, but you want to maximize a little bit, I think there are ways how you can not outsmart the market, but take advantage of those cycles, of those dips. Obviously, as I said, if we're in a low interest environment, then definitely don't want to be sitting on too much cash because that will just do nothing for you. Instead, use that cash maybe to take out a mortgage and start investing into real estate, which is much more cheaper in a low interest environment than when it's expensive, right? Or as I said, in that case, maybe try P2P lending because then you get a higher interest on your capital, right? So there's so many different options. Ultimately, there's no right or wrong. I think it has to work for you, but I think it's important to understand that these cycles exist and that we can either use those cycles for us to maximize our money or, of course, invest into something solid and continue dollar cost averaging. And as the age-old saying goes, time in the market always beats timing the market. But let me know if you have any questions, pop it down in the comments below. I get back to every single one of you. Next up, check out this video over here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.